shaken yet standing firm. This is Radio Cayman in the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. I'm Simon Cawdery and I'm delighted to be rejoined by two noble guests, I'm going to call you. Bill Kelly and Aaron Philbeck, both of whom represent the CAIA Association. So after I've said good morning to you, you're going to have to explain what the CAIA Association is, because it's been a little while since you've been here in the studio. So the listeners may have forgotten. So first of all, good morning and welcome back to Cayman to both of you.
Thanks, Simon. And I like the noble moniker. We'll see if that sticks after 30 minutes. But
I'm going to keep that.
Okay, good. So what is CAIA?
So I'll give you the big picture, and I always turn to Aaron to fill in some of the details. So we're now about not quite 25 years old, and we were born out of diversification. If you think about the endowment model, big pension plans, big endowments and foundations that said, hey, the corporation's only taking 5% out a year, so why can't I go long on the liability side, or the asset side of the balance sheet to match the liabilities, and think about private equity, private debt, real estate, infrastructure, et cetera. That model has now evolved quite extensively, and we're going to talk about democratization in a moment, but our early roots were tied to the big asset owners, and they would take the CAIA designation to understand how you allocate beyond the traditional equity and fixed income space. Point to point today, we have 14,000 members in over 100 different countries. My tenure spans about half of CAIA. I've been there 11 years, and I'm retiring the end of this year. But I think that our very best days are ahead of us because more and more people want access to alternatives. But both Aaron and I are charter holders. We have the CAIA designation. Aaron, you do a lot on the CAIA.
Aaron's got every designation.
He does, yes.
Is there a designation Aaron doesn't hold? Is a question for a whole different show.
We can. That can be the next episode. Yeah. No, I think maybe a couple things to add to fill in some of the things that Bill mentioned. So, as a professional association, we do a number of things. So one is the formal credentialing. So the designation program, our Unify platform that's really focused on non-investment professionals, people who are more client-facing, need a good understanding of the basics of alt. So kind of from a formal education perspective, really hitting across the spectrum of where you're at in your career and where you sit. We also do a lot on just thought leadership and content and engaging with the industry. So whether or not that's long-form white papers, that's getting up and speaking at conferences, doing events like we did last night. We're constantly engaging both with the investment professionals, the regulators, the different universities around the world, to one, kind of help feed some of what we do talk about in the formal education programs, and again, kind of in the industry. But then we're constantly engaging with our members as well. Cayman has a local chapter here that is very engaged with a lot of the different organizations, with the regulator, and putting events on like we had earlier this week. So it's a very broad community of investment professionals beyond those that are formal charter holders who have gone through that formal education program.
I guess one thing that sort of springs to mind, if I were to put my cynical hat on just for a second, is people think of the investment industry and they say, oh, it's all about making money. How important then are these designations, are these qualifications, are these ethical behaviours? There's a group of people who have them. There's 15, 17, whatever thousand it is. But there's many, many thousands who haven't. So to what extent are you fighting a battle that can or cannot be won in that sense?
Well, I would say the outcome is it must be won. Right. But you raise a very important point because it's not easy. And I'm a capitalist myself. I'm not a critic of capitalism. But if I think about this next turn where all of us have responsibility for our own retirement, the defined benefit system that was my parents' generation, it's gone. So I have responsibility for my own retirement. I have to have access to uncorrelated risk premia to yield the best risk-adjusted return over the long term. I think the industry has got to step up around designations, as an example, based in ethics and trying to put that client first. And Jack Bogle said it so very well, the founder of Vanguard. He said it's very hard to serve two masters. And if I'm a big GP, I may be a public company, so I have shareholders that have expectations, I have partners that have expectations, and I have clients that have expectations. And I fear at this turn We're measuring success by assets under management, but whose assets are they? They belong to the client. So they're assets under your management for better outcomes. And maybe last point, and Aaron can fill in the blanks, I think we've got to move from asset gathering to value creation. And if that happens, then both sides win. The GPs do quite well, better outcomes for the end client.
There's a Bloomberg columnist I read or more than occasionally, who said that the best hedge fund is that which keeps client money, not that performs for client money. And that's a concern, isn't it, in the industry, that AUM is important because it's a fee-based industry. And so the more AUM you get, doesn't matter how you're doing. Now, logically, there's some sort of correlation between how you're doing, but not always. And sometimes, especially with what we call alternative assets, which are locked in, it's difficult for clients to move with their feet because they're locked in. So it's a difficult dichotomy to sort of bridge, isn't it, a little?
Yeah, I'm going to let Aaron run with this, but I'll start with Howard Marks from Oaktree. His letters are awesome. He had a great quote many years ago where he said he first heard the term hedge funds in the 1970s when there were 7 geniuses running 7 funds. I doubt we have 10,000 geniuses out there today. And that gets into performance dispersion and median correlations to the public market proxy. But Aaron, some of your thoughts?
Yeah, I mean, so there's a couple, maybe one thing that I'd point to here, you say is fighting a losing battle and alts, and we can talk about whether alts is the correct kind of umbrella term.
Two L's.
It's on my list now.
We'll get there. But alternatives are still relatively small relative to the rest of the industry. So Bill talks a lot about the accounting industry, and we professionalize that industry very early on as the big firms came to market. You had the CPA, the CA, a lot of professional certifications and licenses that professionalize this industry very early. We're kind of doing that retroactively in the investment management industry and trying to retroactively professionalize. But private markets and alternatives are still a very small portion of the overall pie of asset management. So the way that we measure the industry today, quote unquote alts represent about 25 trillion in assets under management, but the denominator is much bigger than that. Whether you're looking at kind of the asset management industry, which is somewhere in the ballpark of 100 to 120 trillion overall, but even the total global investable pie is several hundred trillion in terms of market capitalization. So I actually don't feel like we're fighting a losing battle at this point because it's so early in the life cycle, and we've still got an opportunity, whether it's on the institutional side, to professionalize, credential, even if you're not credentialed, engaging with organizations like CAIA, whether it's going to an event or reading a blog post that we're putting out or engaging with some of our content. We're still very early, and we're even earlier when you get into the wealth management channel, which is still very new to this space. So I'm optimistic in terms of professionalization.
Fair enough. One last thing on this from me, perhaps, is because you mentioned the accounting industry, and I look at the accounting industry. Every one of the big 4 accounting firms has been fined for malfeasance in some jurisdiction. Every one of the big banks has been fined. And so you've got a whole bunch of people in the investment industry who are doing the right thing, getting these qualifications, behaving ethically, but yet they're working for huge firms that the cost of doing business is regulatory fines. So how does an investor get their head around who the good firms are in that sort of environment where everyone pays fines all the time?
Well, it is a back and forth, and a lot of these public accounting firms are now being sold to private equity, and that ownership structure makes me very nervous as well. And I think it's a hard word to get your head wrapped around to a very large degree, Simon. But we mentioned ethics, but culture is so very important. And I think you have to have a cultural fabric of an organization that puts the client's interests first. And it's not always possible, but where it's not, disclose. Tell them that I'm having to make this decision, and you may not like it, but it's in the best interest of the business as a whole. But if the coin is standing on its side, sometimes it should move toward the client. And I think what CAIA is trying to do is, we're not trying to make the world perfect. I know the CFA Society here locally, and you, Simon, you've been great partners for us as well. We're just trying to bend that arc of transparency a little bit more toward the client. And that's easier said than done, but I think culture is a very important part of it.
I think perhaps people who are sitting listening to the show who are saying, I don't know enough about the investment industry to ask the right question, but don't be afraid, perhaps is the message. Don't be afraid to ask what is the culture within your firm. If you see something going wrong, what would you do? ask your advisor that sort of question, because you find out quite quickly, I think, what their perspective is and what their motivations perhaps are.
Yeah, and I think the old saying, if it's too good to be true, it probably is too good to be true. And this is why this Unify program was born, because we've got now a whole series of new investors coming in. This transfer of wealth is probably measured in the hundreds of trillion, over $100 trillion downstream. And these new investors are going to an RIA that may not really know much about private debt or private equity or infrastructure or digital assets, which we can come to. And the purpose of this program is to give them sort of the vocabulary lesson, the courage, and say, hey, understand the basic questions and the follow-up questions.
Yeah, I think, whether you're an individual investor working with an advisor or you're an advisor that's new to this, I think that's a good microcosm of the newcomers into this space, and being able to ask the right questions and being curious about this, I think, is important, and not being afraid to push back on some of those different organizations, because you are, at the end of the day, as Bill said, you're managing those assets on behalf of the client, and so you need to do your due diligence on the front end.
So I think the first line that Bill said, and I didn't write it down, but apologies if I misquote you, the first line you said was something about alpha, about risk premia. And alternatives are $25 trillion dollars in assets under management now. It seems like a complicated subject. I can go to my broker and I can buy shares in a couple of companies. I can buy a few bonds. That's fairly straightforward. I sort of understand that. Most people would think. Then you start talking about risk premium. You start talking about alpha. You start talking about hedge funds, and I go, oh, that's that. I'm not sure I want to do. Why is the language so complicated sometimes?
It's an excellent point, and it doesn't need to be. And I think the basic common sense of not putting your eggs all in one basket. That if you want to have one asset that goes up and the other one goes down, you have better risk-adjusted returns. It's no more complicated than that. But I think even when we start to talk about private equity, it's this clubby, mysterious place. It's opaque. It's not liquid. The fees are high. Equity ownership is equity ownership. Somebody owns this radio station. Somebody owns a company. And equity does not have a conscience or a soul. It doesn't know if it's public or private. But it can be wrapped in two different forms. The private market, less access, concentrated shareholder base, longer hold. Public, there's a secondary market on a regular basis. You can trade in and out. But I think if we could teach the investor one thing, the concept of long-termism. As Warren Buffett said, my favorite holding period is forever. And we've got to think about a long-term investment horizon. And if you do that, your mistakes may look horrendous in the short term. Bear markets can bite very, very hard. But if you invested or even rode the S&P 500 down 55% in the GFC and hung on, you did exceedingly well. But who has the courage to do that? And maybe last point, and Aaron probably has some views on this, is that I don't think anybody held on to the S&P when it went down 55%. But if you only had a 40% equity investment at the time, or 50%, you only wrote it down 25%. So you don't have to have as much to come back again. And I think the goal is around diversification, keep the investor comfortable so they can remain fully invested and smooth out some of those big, big bumps.
Yeah, I think, it's really important, the language that we use when it comes to alternatives. And even, we alluded to it earlier, taking the label of alternatives out of the conversation and really focusing on what does this actually add to my portfolio, and what goals is it accomplishing for the overall allocation? But then secondarily, what am I exposing my portfolio to at the end of the day? As Bill said, private equity is equity at the end of the day. You're just accessing a different part of the economy, of the different part of the investment universe. Credit is very similar. You've got public credit, you've got private credit, and different flavors of credit there as well. Real estate, infrastructure, things that we're touching more tangibly. I think trying to go a level deeper instead of saying...
Don't look at the label. Look at what's underneath the label.
Don't look at the label. Look what's underneath, and think about what it adds to the overall allocation. Your equity allocation should be a mix of public and private, value versus growth, venture versus buyout. It's all kind of part of what you're trying to expose your client's overall allocation to. So the language, I think, is really, really important. 20 years ago, it might have been different. The alternatives were hedge funds. At the end of the day, private markets were very small and early in the life cycle. And so it was a lot more complex. You had, merger arbitrage and long short equity, all these different complex strategies. But the vast majority of that 25 trillion are now in things that we're very familiar with as investors. People can kind of wrap their head around, well, you've got stocks, and then you've got stocks that just aren't traded. You've got bonds, and then you've got loans. Have you ever gone to a bank to buy a car or buy a house? Well, it's a loan. So I think the language and how we explain things is increasingly important to kind of demystify and simplify the alts universe.
So we're just going to take a brief break, having suggested that the language needs demystifying. We'll take a brief break, and then I think we're going to come back and touch on that a little bit more and talk about what language and what sort of forms that can take. So do join us again in 1 minute, and we'll continue our conversation on this investment industry and this use of the word alternative with Bill and Aaron.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense, where I'm joined today by William Kelly and Aaron Philbeck from the CAIA Association. Today's topic is investing, talking about alternatives. And before the break, we touched on this subject of, I guess, what an alternative is and what it's done to people in terms of long-term thinking and the importance of long-term thinking. And I guess I struggle with this one because the whole of the investment industry seems nowadays to be geared towards meeting a need from humans to do things instantaneously. There's instant gratification needed everywhere, whether it be buying clothes, whether it be everything's immediacy. So I can go and open up a brokerage account at Robinhood, I can go and open a brokerage account at Schwab. They can allow me to trade for free. It's not going to cost me anything. That incentivizes me to trade more often. I get excited. I get balloons coming down on the screen. I'm super excited by this news. I've lost all my money, but that's a minor technicality. So how do you rationalize, on the one hand, what is in the best interest of somebody, and then what firms are doing which seems not to be in their best interest? How do you persuade someone to do something that's in their best interest and give up on instant gratification?
It's a very, very complicated future, I believe, that we've got a next generation that is so tech-enabled. There's an app for everything, and robo-advisors, and signing on to Robinhood, and come in because your commissions are free. The commissions are free, but you're paying a price just selling that order flow to somebody else. And you have a platform that is mixing what I believe is full-on gambling with investing. To have options in the outcome of the U.S. presidential election on an investment platform, absolutely absurd. Nobody ever has market timed their way to wealth creation. They haven't been able to do it. It's impossible. So you've got to have a cogent asset allocation plan, put it in place, stay well diversified, and maybe rebalance periodically, but you've got to figure out what gives you pillow comfort at
But
night.
I want gratification today is the app, as you say. Any app, I can go on a date tomorrow, I can do this tomorrow, I can get everything, but investing is, you've got to wait 20 years. That's a mindset which doesn't gel with where humans are today almost, doesn't it?
Yeah, so Aaron might have some of these stats, but the power of compounding, somebody described as the eighth wonder of the world, maybe that was Buffett as well. It is really terrific. If you get money in the ground today in your early 20s and you're putting money aside every 2 weeks through your retirement plan, and the ability to compound by staying fully invested in the equity market, which over long periods of time have returned 8%, it is exceedingly powerful. But it can be watching paint dry if you're looking at it every quarter or every day. But I think we have a news cycle that is perpetual. It's always on and always telling the investor, well, this is going to happen, this is going to happen. And they're reacting to short-term news when they're trying to build wealth creation over the long term.
Yeah, I think when you look at, you look at the institutional investor, the different asset owners that are out there, the long-termism that exists there is because there's some kind of tangible objective that they're managing to. So if you're an endowment or you're a sovereign wealth fund, even a pension, like there's some kind of tangible plan, and so you can kind of build around there, or a tangible liability stream that you're trying to manage against, which almost forces long-termism in a way. When you move into more of the individual investor, and we'll focus on wealth as an example, there's been a bit of an evolution towards more goals-based investing, towards focusing on the financial plan side of managing wealth. And I think the more that you can turn the conversation around, well, this pocket of money is for saving for college, or this is saving for retirement, or this is your intergenerational wealth, or kind of aligning portions of the wealth like you do at the institutional level to a tangible objective that you're trying to accomplish, I think the conversation gets a little bit easier and forces a little bit more long-termism, because in a period like COVID or a period like the GFC, when markets are drawing down quite aggressively, well, I've got this chunk of wealth that's the majority of my wealth that's towards these different objectives, and I don't need to touch it because I'm on track. So the more that you kind of, especially on the front end, both formulate the asset allocation side of things, but what is the asset allocation actually solving for, I think creates that long-termism.
It's just a really difficult human behavior to
It sure is, yeah.
force upon somebody.
And I don't know that you'll fully get rid of it. I mean, I think in particular, the Robin Hoods of the world, you've got instant access to a lot of information. There's always going to be a piece of the market that's trading on a lot of this stuff. And there's a community around that. But I think as long-term investors, you can take advantage of that and not destroy value by focusing on what I'm actually trying to accomplish in the overall portfolio.
Before the break, one of you mentioned you both mentioned the diversity of options that one might have in terms of this alternative space, although whether that's a good word for something that is 25 trillion, perhaps that's a different conversation. But there's this private equity, there's the private credit. There are asset classes which aren't as easy to access, and they have complexity with them. But technology, which we've just been talking about, is evolving, and technology is possibly going down a path which can grant people access to something that hitherto was impossible to access. Is that a good or a bad thing? What do you think it means for people?
Well, I think like everything in life, there's positives and negatives, and we've got to embrace the positives and try to dampen down the negatives. You can't rinse them out completely, but if we use technology as a faster way to invest and a faster way to lose your money, it's not a good outcome for the end investor. But I think we're early days with the advent of something like blockchain, and we had this conversation last night, Simon, and we talked about it before we came on air, that if you think about the public equity markets, it's one big secondary market. We've created a specialist network, and I can buy and sell a stock on trade date +1. I think the secondary market in the private equity space is very new. It only represents 1% of the total 20 trillion that Aaron mentioned before. It's about $100 billion, so it's tiny relative to the denominator. As we develop this and through the advent of blockchain, if we have a price referee, if you think about a distributed ledger, that's great transparency, everybody's looking at it, there's no one common bookkeeper. And if you want to get into this fund and I want to get out, and Aaron's the third shareholder, somebody can help us with price discovery. If we like the price, a deal happens between us. If we don't, the deal doesn't happen. Aaron is not suffering a liquidity event because he's fully invested in the fund. So I think we're very early innings, but I do fear that the technology can get very quickly ahead of the end investor. And Aaron, one of these unified platforms is on digital assets, and we have the advent of spot Bitcoin ETFs, and virtually any asset can get tokenized. So I think, again, there's two sides to that coin.
But
as well.
Can I just go back to that? Because you mentioned the idea that you might in the future be able to invest in private equity, so invest in a fund that invests in companies that are smaller companies that are developing new ideas, building up, and they're a 10, 15-year investment, and then hopefully they'll do very well. And then you have this plan where you can sell that investment if you need to. But doesn't that risk also encouraging the short-termism? Is that not a double-edged sword in and of itself?
It does. So you're not going to be able to please every investor with liquidity. And I think about public versus private markets. I would argue that the small cap market in public equities doesn't exist anymore. So it's not only that the capital formation is happening privately, the innovation is happening privately. So the future of artificial intelligence, healthcare, a lot of these digital-driven discussions we've had this morning, these are all in the private market.
Except the public market proxy is NVIDIA, which is a tool for them as opposed to the solution.
Yeah, and if you want to own NVIDIA, you could buy the S&P 500. The exposure to technology is insane. But I think you've got early-stage companies that have the ability to grow. I think that you do run the risk of bubbles in the public market. So I think that there are some investors that are going to want liquidity. And to be able to provide some proxy for that so they can play in that space, I think it's a better outcome than no access at all. But you raise a very, very important point that the moment we fan the flames of short-termism, That's a very easy concept for the investor to understand. They like action verbs. And if you go to your advisor and say, well, X, Y, and Z has happened. What have you done for me? If the answer is nothing, say, what do you mean nothing? You got to do something. You have the right asset allocation plan in place. This is a blip on the screen. Just go to sleep tonight and rest comfortably. Nobody likes that. They get nervous.
People feel as though they need to earn their fee, presumably.
Yeah, and I was just going to pick up on one thing that you mentioned, Bill, which is I think it's better to open up access to a broad swath of investors, knowing that there's going to be a portion that may not fully understand it, abuse the system or take that short-termism. But the technology has made it so much easier for a wide variety of investors to enter this space, and they're not abusing the system. They're investing for the long term. It's just the vehicles are more friendly from a tax perspective or easier to implement and get access to a lot of these things. So I would just add on to that and reinforce that, opening up access, giving people more tools in their tool belt to be able to invest, I think is a good thing. Now you need to educate on the front end, and you need to make sure people are doing it the right way. But you're always, again, back to the Robinhood comment, you're always going to have a portion of the population that is going to be using this as a short-term trading vehicle.
I guess in theory, done the right way, the democratization of this, the opening up, creates a scenario where you should be able to start to be able to close that gap between those who have money and those who haven't. So this, the huge wealth disparity, because those with money have often got it because of generational thinking, generational planning,
Right.
which is the compounding element. Those who haven't is because they've not done that sort of sensible compounding. And opening up new asset classes, which are much more about longer term planning and much more about compounding, gives that greater opportunity.
Well, and I think the disparity, it continues. I mean, if you just look at the U.S. as an example, the best I can give, like the pension systems are heavily allocated to these, illiquid assets, private equity, and so on. And so those who have those defined benefit plans are benefiting from the allocations that are generating extra income, so on. But the defined contribution space is completely 100% public markets. And so at least giving them the option to invest, and it may not work for them, it may not be appropriate, but it's not even an option at this point. And so that disparity just continues the longer you don't allow people in.
Now, Bill, we've got 30 seconds left, and you're retiring from your role as chief person at CAIA. You've got too many sites. No, I'm kidding. You're retiring from your role. But is there anything you're glad you're not going to be having to experience over the next few years? Is that you glad there's something you're going to put on someone else's plate? Are there any areas of the industry that worry you?
Well, I'm going to answer bluntly, and Aaron's going to ask for a raise, but Bowman's going to have to come through, not me, on that. But it's been an awesome run. As I said at the event last night, I just feel so fortunate to have sat in this seat for the last 11 years. There's not a major city in the world I can't go in and have a drink, a cup of coffee with somebody who I call a friend. It's just been outstanding. But I look at what's happening with democratization and digitization, and these trends, it's like the camel's nose in the tent. They are going to be an enormous challenge and an opportunity. And with many industries, they say it's a younger man's game. I probably have 35 plus years on Aaron, so I leave it up to him.
Don't let him stand for that. More than that. Come on.
But I am still.
I'm thinking about that raise.
Yeah, exactly. Yeah, I'm going to still stay active and involved. I'm going to support Aaron probably domestically on some speaking. I have a podcast, and maybe I'll have you on at some point, Simon, and turn the microphones. But it's I'm looking forward to this next phase.
Well, good luck with that. Look, thank you both of you for joining us on Money Sense. It's been a real pleasure having you on, and thank you for coming down to Cayman to see us all before you do retire and step away from the limelight and thrust others into it. But good luck on that, and thank you very much for joining Money Sense and sort of having a conversation with us today.
Thanks, Simon.
With all that said, just remains for me to say thank you to our listeners for tuning in, devoting some of your morning to our show, and please do rejoin Money Sense again in 2 weeks' time.